we've had 2 directives in the last couple of years, which you can see here. The 4th money laundering directive and the 5th money laundering directive, which are both transposed into law into the UK under the Money Laundering, Terrorist Financing and Transfer Funds Information on the Payer Regulations 2017 and the Money Laundering, Terrorist Financing Amendment Regulations 2019. We also have some really good industry guidance. The best industry guidance that I would tend to use is the JMLSG. That stands for the Joint Money Laundering Steering Group. There's a whole host of guidance documents. The FCA does some, HMRC does some. The JMLSG is a group of bankers and things like that. It's a really practical guide for anyone who's looking to sort of embed a financial crime program into their organization or understand why and how to do things. I think it's something that most financial crime professionals would have on the side of their desk. I thought I would touch a wee bit on the developments of the 5th Money Laundering Directive, since it is the most recent piece of legislation that's come in. There's some new obliged entities. I'm sure if you work in this space that you've heard that cryptocurrency firms have now come under scope of the money laundering regulations. These are crypto asset exchanges and crypto asset custodian wallet providers. They now have to gain authorization from the FCA, who are their regulator for the purposes of money laundering. I think that to be honest, that's really welcome across the board. Having unregulated financial products is not a good thing for consumers or for the market. And having worked with cryptocurrency firms for a long time, they wanted to be regulated. The good ones wanted to be regulated, and they had the systems and procedures ready to go anyway. So all in all, I think that's a really positive step to have been taken. Other new obliged entities are letting agents and art dealers. There's also been a new requirement, which is a difficult one for many financial institutions to swallow. And I'll tell you why. It's the beneficial ownership register, which in the UK is the persons of significant control register, which you'll see on Companies House. So if you search for a firm on Companies House, you can under their entry, look at the person of significant control, and these should be anyone who owns more than 25%, which is the definition of a beneficial owner. The tricky part is that was brought in under the 4th Money Laundering Directive. That person's significant control is in that each member state needed to have a register of beneficial owners. What has happened? The tricky thing for financial institutions is that although this information is there and held by Companies House don't verify that it is correct. So actually, you're not allowed to rely upon it at all if you're a financial institution, which, without sounding a bit callous, it makes it nigh on pointless. Under the 5th Money Laundering Directive, they're actually asking you to correct it. So if you have a client that's a corporate client, and you find that the beneficial owners of that client are different to what is held on the persons of significant control register on Companies House, you now need to report that to Companies House. I think it's via email. They might have an online system or something. If anyone is interested to find out how to do that, please reach out to me after. But it's a tricky one, particularly with firms with a lot of corporate customers. It's a new process that needs to come in. There's also been a recognition of electronic verification and EDAS certification. Electronic verification has been around for a number of years. What they have done is just really recognise it in law, which is a good step. And EDD, or enhanced due diligence, is now required in actually more prescribed circumstances, which include complex transactions and those involving high-risk countries. So those are the developments under the 5th Money Laundering Directive. We're going to deep dive into a little bit of CDD. I should have said at the start that this is the beginnings or the introduction to a series of workshops which Visa are trying to do for its members. So we will touch on each one of these, but moving forward, each one of these will be their own workshop in their own right. I've made a very, very simple slide here to the basics of a financial crime framework. There's stuff missing here before people sort of jump on me. Training, policy, procedures, things like that. They're not listed here. I wanted to keep it right down to the bare bones, and I'll talk you through it. Onboarding, CDD, and KYC are all sort of the same thing. That is, how do you identify, verify, and understand what your customer is. Transaction monitoring, as I said, is a really key pillar to a financial crime program. Once you understand what your client is doing, how do you make sure that they stay within that sort of profile, or if they go outside of what happens, that is what transaction monitoring is. Refresh or periodic refresh is definitely an area where you see problems from startups to scale ups and so on and so forth. Firms typically are trying to grow, and to grow or to get more funding or to be more valuable, they need to get customers. So they get as many customers as they humanly possibly can, and they risk assess these customers, which comes on the sort of the tab at the top there. A risk assessment will take in a number of considerations, which we'll go into later on, but typically a customer will be low, medium, or high risk, and that will push them into a periodic review cycle, which is either for low 3 years, for medium 2 years, or for high every year, as an example. Typically what you find in startups is that they don't prepare for this. Or they don't give it sort of the consideration for resource that maybe it's required, and people end up doing it on the side of their desk, which can cause problems later on. The final part is a compliance monitoring plan, or CMP. And this is key to making sure everything else is working as you think it is, or as it should be. You should be doing tests on your customer files and your client files, making sure that your CDD is working correctly, your transaction monitoring system is working correctly, you're doing PEPs and sanctions checks correctly, the databases are getting updated, your staff are getting trained properly, and all this sort of stuff. It's really, really important, and it's something that adds a lot of value. So if we're going to move on and sort of deep dive into something, we'll start with customer due diligence. And I've put up some of the information there from the legislation, which is you must identify the customer and verify their identity, identify the beneficial owner in corporate clients, and where relevant, verify their identity, and assess whether appropriate to obtain information on the purpose and intended nature of the business relationship or transaction. If I was going to take that back a step and just go, right, what is customer due diligence and what is KYC, which is a different thing. Customer due diligence is identifying who the person is and verifying that identity. So if I was going to sign up with you, if you're a financial institution, I would typically give you my name, date of birth, and address. That would be typically part of an application form. That firm will then verify that identity. Now, years gone by, that would have been verified by me supplying a passport and a utility bill. Now there's a whole host of electronic means of doing that. You can either use data or biometrics, and data is, you can use the information that I've supplied and hit that against, a number of different, using GB Group or an Onfido or a True Narrative. You can hit that data against a number of different databases. And on the basis of the number of hits that you get for that data, of my name, date of birth, and address, you come up with a score. And that score will either pass or fail. It negates the need for a passport or a utility bill. And there's also the biometric stuff, which is the selfie and my driving license up beside it, or my passport up beside it, and it does it sort of in an automated fashion. You need to understand how these things work, but they're very, very useful tools if you're looking to scale correctly. KYC is something a little bit different to CDD. So CDD, now I've said I am who I say I am. You've verified that I am who I say I am. So you and I both know that I am Philip Creed. KYC is understanding why have I come to you. do you offer, say, a currency card or something like that? Well, have I come to you for that? Or do you offer cryptocurrency? Have I come to you for that? Do you offer an investment product? Have I come to you for that? And does the product that I'm looking to do fit with the type of person who I am? That is what you're trying to understand whenever it's KYC. So these all sort of fit together. If I was going to say CDD is almost the data, KYC is understanding the why, and that all sort of filters into the nature and the purpose of why I have come to you in the first place. Moving on to the next part, it is transaction monitoring. And again, I'll put in sort of the obligations from the MLRs, which the relevant person, which is the financial services institution, must conduct ongoing monitoring of a business relationship, including scrutiny of transactions undertaken throughout the course of a relationship to ensure that the transactions are consistent with the relevant person's knowledge of the customer and the customer's business and the risk profile. So, I am Philip Creed, and that I have come to you for a currency account, and roughly I maybe want to put £3,000 into that card to use whenever I'm on holiday. So what sort of transaction monitoring rules are you going to apply to me to make sure that if I go beyond that, if the activity goes beyond that I get highlighted? So if I, for example, put £100,000 into my currency cloud, that should flag. It should flag for your compliance team to pick it up and go, well, that's not what Phil said he was going to use this for. We're going to have to reach out to Phil and find out what he's up to. There are some tasks in practice that we've highlighted there. You can do monitoring in real time or retrospectively. You can do it manually, or you can do it with an automated system like ComplyVantage or Napier. Your monitoring system can be in two ways. So it can be a fixed set of rule sets, which is not ideal anymore, which would have been, if, for example, I did a transaction over £100,000, it would highlight a rule. But those fixed rules aren't particularly ideal. What the best type of transaction monitoring actually fixes the rules against my profile. So it says, no, Phil Creed in particular is going to do this, and I need to set this, and this rule out against Phil Creed or a group of people who are similar to Phil Creed. Effective systems are likely to include unusual natures of transactions, the nature of a series of transactions, any geographic or origins of payments that are a bit weird, and any other parties that are concerned. So if I start dealing with somebody else that is a blacklist, that is something that you would want to take into consideration. Periodic refresh is sort of the naughty secret. I think that's maybe the best way of putting it. As I mentioned before, periodic and ongoing refresh typically comes out of your risk assessment. So you will have risk assessed your clients as low, medium, and high risk. You will have said, okay, well, if none of our sort of transaction monitoring rules or anything like that flag, we will look at you on a year, 2 year, or 3 yearly basis. Again, why this is an issue with startups over more mature firms is typically that they try and onboard customers. I think Monzo, and just take Monzo as an example, has 4 million customers in something like 4 years. I think they started in 2016. All of a sudden, out of those 4 million customers, say, maybe they only had 1 million join this year. A lot of those are due for periodic refresh, which is basically an onboarding all over again. So they may have scaled their onboarding team to get these 4 million customers on board, but the periodic refresh is maybe something that they haven't set aside resource for, because it's always something that's in the future. You would see this quite a lot. We would do a lot of financial crime audits on financial services firms, and typically there is a backlog and periodic refresh. Now, the regulator, the FCA, particularly for money institutions, is coming down on this pretty strong at this minute in time, and it's something that you need to give. If you give due care and consideration at the start, it's a lot easier to deal with. Once people start doing the periodic reviews and the ongoing refreshes on the side of their desk as they were doing all the other jobs that they were doing, which is typically what happens, these backlogs start to occur, and they're very easy to pick up from a regulatory point of view, and it's something that if you consider it at the start, is very, very straightforward to deal with. So periodic and ongoing review is definitely an area that I'd like to highlight for firms that are starting up or scaling up to consider. It's definitely on the regulator's radar. So we're going to talk a wee bit about a risk-based approach. I will start talking about a risk-based approach by saying it is very specific to the financial institution that is trying to build it. You cannot take a risk-based approach from a Barclays and put it into Santander. It doesn't work like that. And I'll explain why a little bit later on. But the purpose of a risk-based approach, and I'll probably say this 4 or 5 times, is to focus your resources, your firm's resources, on the areas of highest risk. So I've got a question here. What does the acronym CTF and UBO stand for? CTF is counter-terrorist financing, and UBO is ultimate beneficial owner. Sorry, the ultimate beneficial owner is anyone who owns or controls more than 25% of a business or of an entity. The risk-based approach is, as I said, is specific to the firm that is doing it. It's key because you want to focus your resources on the areas of highest risk. You also need to understand what your firm's risk appetite is going to be. So you may accept more risk. For example, I have a client who only offers savings products to UK individuals over the age of 40 or something like that. That's an incredibly low risk product. As such, your appetite for risk is incredibly low. I have a number of other clients who offer wholesale services to other financial services companies. So in a way, the underlying client is another one removed from my client. And as such, that is a high risk business. So your risk appetite is a lot higher. Your risk matrix and the appetite need to work together. There need to be something that makes sense together. To produce a risk assessment, the JMLSG and the money laundering regs highlight sort of these 5 key buckets that you need to consider. Product. So what products do you offer? Do you offer a currency card? Do you offer an FX transaction? Are you offering cryptocurrency? Are you offering an investment product? What is it? You need to actually risk assess those products. You may offer a multitude of products, and you may offer them all to a client, or you may only offer some if they meet criteria, so on and so forth. You need to be able to really, really go heavily into that. Client, who am I? You need to risk assess me. I could be a private individual. I could be a limited company. It could be a trust. I could be based in, we'll come into geography, but it could be a trust, could be a law firm, could be whatever. You need to make sure that the client is who they say they are, and different types of entities have different risks attached to them. Geography, where am I based? That is, where am I resident, but also where am I physically located potentially. You could use IP addresses or things like that to help with that. There's also transactions, and transactions will be sort of transactions volume, or what types of transaction am I going to do, what products am I going to use within those transactions, where am I receiving money from, where my source of funds coming into it are, where am I sending money to, so where the beneficiary is located, and you can play that back into the geography. And delivery channels, so how do you get your clients? Is it online? Is it face-to-face? There's different risks attached to meeting somebody against not meeting them at all. All of this needs to play into sort of your overall risk assessment. And finally, we're going to touch on sort of the thing that keeps it all together, which is a compliance monitoring plan, or a CMP. A CMP should be testing that everything that you've done is working. So if you use an onboarding platform to onboard your individual or corporate customers, you'll want to make sure that that is doing as it said it would do. So you may test it with your own name and a different date of birth or a different address or something like that, make sure that it would fail. You would also want to test your risk assessment and by pulling out a number of different clients that are low, medium, and high risk, reviewing their client file and seeing, are these actually correct? Because particularly when you're starting up, you'll create a risk assessment in theory. We think our clients are going to be this type, this type, this type, this type. In actual fact, our clients are a whole load of different types, and your risk assessment, whenever you first built it, may not be fit for purpose. But the compliance monitoring plan is supposed to pull in data and use data to improve that. You'll also need to have a look at, well, I'll list off the ones that we have on here. Systems and controls, so that is making sure everything is working. Your client acceptance process, so when, for example, a client is high risk, you may say this client needs to be escalated to the MLRO. Is that happening? Is there an audible trail for a regulator if they came in to check? Is your risk assessment effective? As I said before, can you pull out MI from the last month, 3 months data, and see, okay, well, are these clients, is the risk assessment working as we thought it would do, or do we need to amend it slightly, or what, are we bringing out new products or whatever? Keeping an eye on your periodic review. So are there backlogs? Do there need to be more resources attached to it? And your policies, procedures, and record keeping. So most AML manuals, policies, all this sort of stuff needs to be at least reviewed on an annual basis. Has that been done? Or there may have been a legislative change. You'll have seen there that the 4th and 5th money laundering directive came quite quickly together. There's also the 6th, which is coming out very soon. So are your policies and procedures updated for that? And also, we'll have a wee look here in the key factors, but there's escalation processes, policy procedures talked about, MLO sign off, training. AML training is an annual requirement, so has everyone undertaken their AML training? If you have new starts, have they taken it within what your policy says? So normally they'll say maybe within a month of joining, they'll have to do it. The important thing about a compliance monitoring plan is producing good MI. So you may have, and MI is management information, which you would like to report to the board. So it's almost like a mini MLRO report. And doing that is incredibly effective to manage your financial crime program. So we want to talk a wee bit about the emerging payments and the implications. And this is talking a wee bit more on the general pitfalls of the digitalization of the AML process. Most of it is understanding the technology that you're using. Okay, so for CDD, people will use, for private individuals, will use some sort of onboarding system, whether it's GB Group or Onfido or whatever. They'll maybe use a combination. They maybe use data, which, as I said, is using my data to hit against maybe credit reference agencies, maybe bankruptcy information, whatever, to figure out if I am who I say I am. They may use biometric data to figure out what I say I am. The GMLSG is quite clear on what is acceptable in these scenarios now, and it must be 2 plus 2, which is 2 hits on my name and address and 2 hits for my name and date of birth. So you actually need to go under the scoring mechanisms of these and making sure that that complies. And I would also like to see that in your AML manual or in your AML policy, because it shows that you've given due care and consideration to the technology that you're using and its limitations or not. So PEPs and sanctions is also a very big one. People would use PEPs and sanctions tools all the time. What is your fuzzy logic matching? Fuzzy logic is not a perfect science, and almost by definition, if you understand what your fuzzy logic is, you have taken some sort of risk-based approach to it, because you will never catch everything. A classic problem with fuzzy matching is if the person's name is John Smith, that's a problem just because it's a generic name, but it's also a problem because it doesn't have very many characters in it. And the fuzzy matching doesn't work particularly well whenever there's sort of 4 or less characters involved in it. But you need to understand how that works. You need to document why you've taken that approach. Transaction monitoring systems are very much the same. You see, they've come a long way in sort of 5 or 6 years since we've seen a lot more competition in the area. But certainly initially, people would implement transaction monitoring systems with a generic set of rules. These could be 10, 12, 15 rules or whatever, but these rules were not configured correctly for their business. So it could have been rules that applied to private individuals and you only dealt with corporate customers, or vice versa, or whatever. And the problem with a poorly configured transaction monitoring system is you end up with too much noise, too many alerts, and too many things to deal with. And as such, you're not actually picking out the good stuff, the juicy stuff that you need to actually deal with. So configuring your transaction monitoring system is incredibly important. Those are the sort of 2 main areas where the digitalization of AML processes have come a long way. There's also company onboarding. You'll see the likes of Tide and stuff doing this very well. They take a very interesting approach, which company onboarding is impossible to do end to end. Is the long and short of it. Data can only get you so far. You will need to reach out to directors and beneficial owners and get a certain amount of information and that sort of stuff. So again, you need to understand, I suppose if I can say anything, is the technology is great, data is great, even company data is great, company's house is amazing, but you need to understand its limitations whenever it comes to implementing a financial crime framework. I suppose, if I could leave you with anything, and before I go back to the questions, I'll leave you with this, which is, if you're starting up, or you're thinking about starting up, or you need a financial crime pulled together, these are sort of the key things that you need to think about early doors. How you're going to onboard your customers, and how does that work? How you're going to monitor their transactions. And I think that you should be giving due care and attention to periodic refresh. A risk assessment is something that you need to spend a good amount of time. You need to understand what products you're offering, what your customers are going to be, and that sort of thing. And a compliance monitoring program helps hold it all together. So listen, I know that we're coming up to sort of the final address and closing remarks by Tony. So without further ado, if you have any questions, please feel free to ask. I'd be delighted to have it. I'm pretty sure Ailes and the guys at PAY360 would be happy to share my details if somebody wanted to ask me something privately. So please go ahead and ask any questions, and let me know if there's anything further that you need. When is the Money Laundering Directive 6 coming out? Let me just check. It came into force on the EU level in December. Member centres are required to implement it by the 3rd of December. However, I'm not entirely sure. And let me come back to you on that. I'm pretty sure it's coming out in December, but I'll double check. There's one from Tony. How does compliance have to change with the arrival of cryptocurrencies? I love cryptocurrencies. I love them as a thing. We do a lot of work with chain analysis, and I know that there's other providers, but everyone compares cryptocurrencies to bank. If you compare cryptocurrencies to cash, then all of a sudden it's really different league. Things like chain analysis can track a transaction of Bitcoin right back for 10 years. It can also assess a cryptocurrency exchange for the amount of dark money activity. The amount of investigation you can do on cryptocurrencies is really good. To answer it directly, how does compliance have to change to the arrival of cryptocurrencies? It doesn't. The fundamental pillars of a financial crime framework is the same. You will just be using different tools to deal with it. But again, the actual fundamental areas are different. Here's another one. Is it worth getting formal qualifications and training in compliance, or do you think we can do fine by learning on the job? It's definitely worth getting formal qualifications. That is 100% fact. The ICA do good compliance training. I know the guys at the Emerging Payment Association do a lot of workshops. I think it's always beneficial. Like, we run a graduate program at fscom, and every single one of them does an ICA diploma in financial crime compliance, or there's another wider one, I think it's investment compliance. And the reason for that is it gives you a really good base knowledge, and then you can work upon it. You kind of need the base knowledge to be able to deal with problems that you maybe haven't foreseen that well better. So I think it's certainly a good thing to do. Okay, I think that's probably it. Again, thank you very much, everyone. I do believe this recording is going to be made available for people to view post-event, so please feel free to go ahead and do that. And otherwise, please enjoy the rest of the conference, because I know I've enjoyed it so far. Thank you very much.